Everyone's obsessed with the Magnificent Seven, but here's the problem. By the time a stock has scaled the heights to join the club, most of the big money has already been made. The real opportunity is finding the next market leaders before the rest of the crowd does. That's why today I'm breaking down 7 AI stocks that have the setup, the ratings, and the catalyst potentially be the dominant winners of the future. Let me introduce myself. I'm Steve Reitmeister. I've been investing for over 40 years, almost half that time as editor-in-chief of Zacks.com, and now I'm a partner at WallStreetZen.com. Now, over the decades, I've learned a lot about locating high-quality stocks. I'm happy to share my insights with you today. So if you like to discover exciting stocks backed by real data and catalysts, then please hit that like button right now. It helps me know what types of videos to record more of in the future, and it helps you see more high-quality content. All right, and now the last thing before I get to those 7 AI stocks. I'm sharing stock ideas, but any decisions about what to buy are yours and yours alone. So always be sure to do your own due diligence. Okay, let's get on to those stocks, starting with number 1 in ChipMOS Technologies with the symbol of IMOS. It's possible you've never heard of this stock. That's sort of the point. They're a Taiwan-based company that specializes in packaging and testing high-density memory chips. Unglamorous work, but pretty critical right now. Most people think of AI as a software story, but every model running in a data center needs massive amounts of high-speed memory, and all of it has to be packaged and tested before it ships. Advanced packaging has become a first-order growth limiter. Even when chip manufacturing capacity exists, packaging throughout determines how many AI accelerators actually make it out the door. ChipMOS sits right at that bottleneck. That has all translated to 25% revenue growth, with management citing strong AI and data center demand, helping to improve long-term visibility. The Zen rating is a solid B thanks to its top 14% showing out of all stocks based upon its impressive fundamental profile. And yes, this equates to a buy recommendation with increased odds of future outperformance. Looking at the component grades that make up the overall rating, there are 3 key areas of strength. Growth grades at a B, ranking the top 10% of stocks tracked. Even better is the momentum grade, which is an A, ranking the top 1% of the 4,600 stocks we track. They also score an elite A grade for a proprietary AI factor. And just to be clear, this isn't measuring whether the company simply has exposure to AI hype. Rather, our AI factor is a machine learning model trained on more than 20 years of market data. It looks for subtle combinations of earnings trends, cash flow, price action, and industry behavior that have historically pointed to future outperformance, often before the broader market catches on. This stock is not without risk. Remember, this is a cyclical business, and any slowdown in data center spending would certainly hurt the company. But management is signaling customers are booking further out than usual. That typically leads to higher profit margins, higher earnings growth, and yes, dear friend, higher share prices. That is why we think the stock makes a great start to our list of future AI winners. Let's move on to stock number 2 with Ciena with a symbol of CIEN. When most investors think about AI infrastructure, they think about the chips, GPUs, and data centers. But there's another layer of the AI stack that almost nobody talks about. We're talking about the network, and that's where Ciena comes in. Ciena builds the optical systems that move massive amounts of data between AI data centers at ultra-high speeds. And as hyperscalers build interconnected AI clusters that function like giant supercomputers, demand for that infrastructure is exploding. In other words, AI isn't just a computing story anymore, it's a connectivity story as well. The numbers are starting to reflect that shift as Ciena recently raised its fiscal 2026 revenue growth guidance to between 21 and 29%. This is driven heavily by hyperscaler AI demand. And to put that into perspective, it's one thing for a small startup to grow revenue 25% a year. It's a lot more impressive when a nearly $6 billion infrastructure company suddenly starts accelerating because of that AI demand. That's the kind of growth curve that prompts investors to pay attention. Now, the Zen rating seconds that motion, with Ciena scoring a B rating overall, which means a solid buy recommendation. All in all, it ranks in the top 15% of all stocks in the quant model for its fundamental prowess. Looking at the component grades, I'm impressed by the above-average B for safety, which is unusual for an AI growth stock. The solid grades don't stop there, as they also get Bs for both financial strength and momentum. Its growth grade is an A, ranking in the top 1% of stocks we track. This is a large part because they are growing 3 times faster than industry peers over the last few years. The biggest risk for Ciena is customer concentration. A relatively small number of hyperscalers drive a large portion of revenue. But the counterpoint is equally powerful. Those same hyperscalers continue increasing AI capex aggressively, and Ciena's backlog already gives the company unusually strong forward visibility. Combine that with the top 1% rating for growth, and you understand why Ciena is on our list today. Before we get into the next stock, here's what you should do next. Please hit subscribe and tap that notification bell. That's because I release stock pick videos like this quite often, and that's the best way to ensure you don't miss the next one. All right, moving on to stock number 4 with Vertiv with the symbol of VRT. Everyone talks about the computing power that AI requires. Very few talk about the tremendous heat generated. That's why cooling of data centers is quickly becoming one of the biggest bottlenecks in the entire AI industry. That's exactly why Vertiv has become so important. Vertiv builds the power and cooling systems that keep AI data centers running. Think of them as a leading picks and shovels play for the AI infrastructure boom. As AI chips get more powerful, traditional air cooling systems stop scaling. Modern AI racks are now pushing well beyond 100 kilowatts, making liquid cooling the new industry standard. The market is expected to grow more than 30% annually through the next decade, and Vertiv is already one of the key players positioned to benefit. That's the structural shift. Now here's the current catalyst. Vertiv's most recent earnings report crushed expectations by rising 83% year over year. Management then bragged about a backlog approaching $15 billion, giving them confidence to expect 51% earnings growth in the year ahead. Wall Street has taken notice. This explains how Vertiv enjoys a strong buy consensus, with over 90% of the analysts issuing buy or strong buy recommendations. The Zen Ratings has taken notice as well. It scores a B grade because it ranks in the top 10% of all stocks for its stellar fundamental profile. Now, as we drill down into component grades, we can see specific areas of excellence. Its growth grade is a well above average B, the top 18% of all stocks we track. Momentum even a notch better in the top 6%. But the real standout is the A grade for financials, placed in the top 3% of all stocks we track. This is a sign of management efficiency and operational strength that often shows up in future earnings beats. In simple terms, the company appears to be experiencing strong demand and demonstrating strong execution. The obvious concern here is valuation. At around 49 times forward earnings, Vertiv trades rich for an industrial company. Now, that's real, but context matters. When backlog doubles in a year and the underlying market is projected to grow more than fivefold by 2033, the current premium starts to look a lot more understandable. Vertiv is not being valued like an industrial company. It's being valued like critical AI infrastructure, which it most certainly is. All right, we're going to keep the party moving with stock number 4 in Dell Technologies. You know the symbol, and everyone knows this company. Most investors think of Dell as just a PC company. That view is becoming very outdated. Dell has quietly become one of the biggest suppliers of AI servers and infrastructure, and that demand is accelerating fast. The company recently landed a massive AI infrastructure deal, helping push the stock near all-time highs. And the most recent earnings report was truly special, as their AI server backlog continues to swell. This isn't a speculative small cap riding on AI hype. It's a global infrastructure giant directly participating in the massive AI buildup. Not surprisingly, Wall Street is taking notice, with 75% of analysts covering the stock giving it a strong buy or buy recommendation. Dell is also currently receiving a B grade from the Zen Ratings model, yet it is knocking on the door of Elite 8 territory, as it ranks in the top 8% of all stocks we track. As you would expect, the growth component grades is one of the strong suits, given robust results, and higher guidance continues to validate this positive outlook. Its financial grade is a B as well, reflecting a company with strong financial health, and its momentum grade is an exceptional A, as the company has been enjoying upward momentum supported by strong investor interest. It is worth noting that Dell is fundamentally a lower margin, high volume hardware business. It's not a pure play AI compounder like some software names, but that's also part of its appeal. The company sits directly inside what could become a multi-year enterprise AI infrastructure cycle, while maintaining the scale, relationships, and operation stability that many smaller AI companies simply don't have. For much of corporate America, Dell is still the default vendor. And in a large technology transition like this one for AI, the default vendors often win, and they win big. Now let's flash on over to stock number 5 in SanDisk with a symbol of SNDK. SanDisk just became something the market hasn't really had in years, a pure play NAND flash memory company. And in the AI era, that suddenly matters a lot more. Training AI models doesn't just require a lot of computing power. It also requires enormous amounts of ultra-fast memory and storage infrastructure, moving data continuously between accelerator servers and AI clusters. And that's the key shift. The proportion of hyperscalers' CapEx allocated to memory is projected to rise sharply in the coming years. AI training clusters are consuming storage at a pace the industry simply wasn't designed for a few years ago. And as that demand accelerates, NAND pricing and profit margins are moving aggressively higher. Current expectations are for NAND prices to roughly increase 70 to 75% quarter over quarter. Let me repeat that again. Prices to increase 70 to 75% quarter over quarter, driven primarily by AI data center demand. That is a tremendous macro setup for strong profitability. SanDisk has already secured roughly $42 billion in long-term supply agreements with the hyperscalers. That number is staggering for a company this size because it creates visibility that memory companies historically never had. Management also announced a massive $6 billion share buyback program, a strong signal they believe the market is still undervaluing the business at this time. The pure play structure is what makes the story especially powerful. Every dollar of NAND price improvement now flows almost directly to SanDisk's bottom line. That not only explains the positive view of shares by Wall Street analysts, but why they expect SanDisk to stay on the upswing even with the impressive gains already in hand. Now, the Zen ratings see SanDisk as a truly exceptional company. After reviewing the stock across 115 unique fundamental factors, it scores in the top 1%, pointing to great likelihood of future outperformance. This includes top-notch component grades for growth, momentum, sentiment, and financial strength. It's difficult to find this many strong grades for a single company like this. It's truly rare in a high-growth technology name. Now, the obvious risk is cyclicality. Memory has historically been one of the most boom and bust industries in technology. So if AI CapEx slows faster than expected, then NAND pricing could reverse sharply, as would SanDisk shares. But this cycle looks structurally different from prior memory cycles. The $42 billion in locked supply agreements gives SanDisk more forward revenue visibility than ever before. This isn't the old commodity memory trade where supply appeared overnight and collapsed margins immediately. A significant portion of future demand is already contracted. This completely changes and improves the investment setup. And that is why I'm a big fan of SanDisk. Okay, we're moving on to stock number 6 in Nvidia. Yeah, Nvidia is already part of the Mag 7, but the signs are they will continue to be a power player into the future. Let's talk about why there still may be a sizable opportunity left after one of the greatest runs in market history. For one, the next major catalyst is already forming. Nvidia's next generation AI platform called Vera Rubin is expected to launch in the second half of 2026 and will require next generation HBM4 memory, creating another powerful demand wave across the AI supply chain. At the same time, enterprise AI adoption is still relatively early. The first wave of AI spending came mostly from the hyperscalers. The next wave could come from corporations globally building their own AI infrastructure, and that demand may not be fully priced into shares this time. Okay, true. Valuation of these shares is no longer cheap. But what continues to separate Nvidia from a typical momentum stock is the financial engine underneath it. Extraordinary earnings growth and extraordinary cash generation at truly massive scale. Wall Street analysts continue to be very bullish on shares, even with the gains in hand. We're talking about 17 strong buy and 8 buy recommendations. Even better is some of the fair value price targets still implying over 100% share price appreciation potential in the year ahead. And yes, the Zen ratings is picking up on what is still special with Nvidia, leading to a sparkling A Zen rating, which amounts to a firm strong buy recommendation. The standout component grade is for financial strength, scoring the top 1% of all stocks analyzed. Hype-only companies don't produce elite financial metrics this scale, but Nvidia most certainly does. Now here's the interesting part. Its momentum grade is only a C. This is amongst the lowest momentum grades on any stock in our list today. And it's because Nvidia and many of the other large tech companies lost some luster earlier in 2026. All the while, their earnings prospects only grew brighter. This may be the opportunity for latecomers to finally hop on board the Nvidia bandwagon. All right. Before we discuss our last pick, I have one important thing for you to do right now, and that is to join me this Monday at 7 p.m. Eastern Time for Wall Street Zen Live. That is when I share my updated market outlook, trading plan to beat the market, and top 7 stocks for the week ahead. All that and more this coming Monday. So time to claim your free spot for Monday's live session at 7 p.m. Eastern. Just sign up now at wallstreetzen.com/live, or follow the link in the description, or scan the QR code on your screen. Whatever you do, please be sure to join me this coming Monday. All right, let's finish up with stock number 7 in Micron Technology with a symbol of MU. This is most certainly making a strong case to break into any future Mag 7 arrangement. Micron Technology makes one of the most important pieces of the AI boom. We're talking about high bandwidth memory, what they call HBM, which powers advanced AI chips. Every top-end Nvidia AI accelerator depends on it, and only a few companies can produce it at scale. Micron is most certainly one of them. Warranty, Micron is no longer just a cyclical memory stock. It's become a core AI infrastructure winner. In fact, its entire 2026 HBM supply is already sold out under non-cancelable contracts. Yes, already sold out. That alone is the main reason behind the recent explosion in revenue and profits. What do I mean by explosion in profits? Well, how about current Wall Street estimates pointing to over 600% expected earnings growth this year? Yeah, that kind of explosion. Wall Street analysts also remain overwhelmingly bullish on the stock. This includes 19 strong buy and 7 buy recommendations. Note there is not a single sell rec on the stock. Lately, analysts have been playing a game of one-upsmanship with higher and higher target prices given the soaring earnings outlook. Right now, the top target price suggests over 70% more to rise in the year ahead. Micron not only scores an elite A grade for the Zen ratings, but actually scores in the top 1% of all stocks analyzed. It boasts 3 A's in the component grades that are worth talking about. First, we're talking about an A for momentum, meaning the market is already recognizing the strength of the story and the share price. Next is growth, where it ranks in the top 2% of stocks tracked, reflecting just how explosive the company's earnings and revenue expansion has become as AI memory demand accelerates, and its financials grade is an A in the top 2% of all stocks tracked. This is driven by rapidly expanding margins, strong operating leverage, and serious cash generation. Now there is one flag worth acknowledging, and that is about supply expansion, meaning their main competitors in Samsung and SK Hynix are both aggressively increasing HBM production capacity. If supply eventually catches up with the soaring demand, then margins across the industry would compress, and that is the main bear case for the few bears that are out there. There aren't many. But in the near term, Micron's setup remains unusually strong because its capacity is already fully booked through 2026 under non-cancelable contracts. Plus, many analysts say this demand cycle is unlike any they've seen before, especially how long it may last, providing a lot more earnings growth and share price gains in the year ahead. I most certainly am on board the Micron bandwagon. Perhaps you should be too. Today, we covered 7 AI stocks that could help form the next Magnificent 7. Not just the companies grabbing headlines today, but the businesses quietly building the infrastructure powering the AI economy. From semiconductors to memory to data center cooling, networking, and enterprise AI servers. These are the companies positioned behind the next big phase of AI growth. Now it's your turn. Which of these stocks do you like the most and why? Please jot it down in the comments section below for the benefit of our community. Now I suggest you continue your education with my recent video about robotic stocks with significant upside potential. I hope you enjoy it.